As an emerging private equity fund manager, the first thing that I had to do was go find people who had a lot of experience. Now, I didn't come into it with no experience. I had sold a couple businesses, helped a lot of other people sell businesses. But the biggest thing that I had to go do was find people who had executed, front to back private equity strategies before and had great success with them. And so, welcome back to another episode of Deal Flow Live. I'm one of your hosts, Brody Vinson.
I'm your other host, Ryan Santo.
And in this episode, we're going to be breaking down what is a private equity roll-up? How did I go find someone who, had done it before? What did that look like? And we're going to talk about how you find these opportunities and how you actually bring them into reality, because there's a lot that goes into this. So without going too into the details, I went out and I found someone who had executed a successful private equity roll-up that just finished about a year and a half or two ago. And what he did is he went out and bought 5 companies in a particular industry, brought them together in under 2 years, and got a 6.7x return on invested capital, or multiple on invested capital, which also equated to a 170% internal rate of return. And this is the kind of returns that you can get with strategies like this, but it's very important that you understand where the opportunities actually lie and don't think that just everything is a target. So Ryan and I wanted to break down what does this actually look like? What is a private equity roll-up? How does it start? How do you start it? How do you continue adding on to it? What kind of market research goes into identifying whether these opportunities are good or not? A few other things. So the first thing I wanted to talk about is what is a roll-up itself. So a private equity roll-up, very simply, is identifying a particular industry or set of industries that relate to each other that then you can go buy a few companies in and, roll them all up together. So Ryan, when you think about roll-ups, what are the types of industries that you think are most appealing?
I think personally it's home services to start. I know our channel is very focused on those, but I like a business that is physical, in a place where I can see potential to add on more area of business through a roll-up. Another one that we have been talking about, but I've also seen a lot of potential in, is accounting and financial services. While that can be done in person, that can also be done digitally. And I think between bookkeeping and accounting, you can serve a lot of people very easily in this regard. So those are my 2 go-tos. I do think there's some other expertise businesses that you can do bolt-ons and roll-ups with if you have the knowledge, like pet services, staffing. These are also good businesses, but they are more risky for those who do not have experience in the space, I think.
Here's the number one thing I think of, and I think you're spot on with a lot of those. The thing that a lot of those have in common is that they tend to be very fragmented. I think whenever you're looking to do a roll-up, you want to pick an industry that is fragmented versus consolidated. So what does that mean? Fragmented, all that means is that rather than in a particular industry, rather than all of the market share or the customers being held by 1 or 2 or 5 or 10 key players, it's actually spread out between a lot of smaller companies, like hundreds or thousands of smaller companies. The more that there are, the more fragmented it is. Whenever you see something that's incredibly fragmented, like if it's thousands and thousands of companies all operating in this one particular industry, take home services, for example, where there's a lot of little like mom and pop operations, some that have like a few people working for them that are great companies, but there's hundreds or thousands of them in each 1, 2, or 300 mile radius around the US. That's very, very fragmented. And that means that if you were to go try to buy a bunch of those companies, there's a lot of options. You're not just playing with a few major competitors that are going to be guarded off and it might be hard to acquire businesses in. They're very fragmented. So I always want to be thinking about companies like that. Accounting, like you said, is another great example because there are so many little like mom and pop style accounting firms, and you could go on, if you're a really established player, go and acquire them. So I think the first thing to understand is the difference between a platform company and an add-on company. And the difference simply is, if you're doing a private equity roll-up, the very first company that you acquire is what's called the platform company. The reason it's called this is the infrastructure that you're going to then go build off of with the other ones. So this has to be, in my opinion, and from what I've seen, people who have done it successfully, this has to be the company that's the best one, that runs the best, operates at the highest level, and has the strongest operations and competencies. So what do you look for to determine that? I think the first thing is the profitability. The first and most foremost thing is the profitability. For the deals that we look at, we really only look at a platform company if it's about $1.2 million in profit per year. That's after all of the expenses, 1.2 million plus or so in profit per year, because we know that it's at that level where it's big, it's like gotten something right. The other things we look for are recurring revenue. The more recurring revenue that it has, the better, the tighter operations it has. And then of course, profit margin. So if it's a company that's doing $20 million in revenue a year, but it's only got $1 million a year in profit, then that's not a very good, stable company to rely on, versus something where it might have 30, 40, 50, 60% profit margins. Then you've got a good, solid operation that you can build off of without worrying too much about fluctuations with it.
I mean, that's kind of the baseline that we always use. And I think that profit margins are one of those things where it's heavily industry heavy, like where an accounting firm may have a profit margin of X, HVAC has a different one. So you have to also be reasonable with what industry you're looking at. And just because maybe you can't go out and get a platform company right now doesn't mean that you can't buy, like we always show, those smaller businesses that are doing good cash flow for somebody who just wants to own a business and become, get that part of their life started. You could grow that smaller business into a platform company if you have, the time and the patience to do that. I mean, you can run it as is, or you can grow it to that point. At certain points, you're going to need to bring on new expertise. You're going to need to do expansion. So I know Brody has done at least one, buying a small company and making it a platform company, just because he has the time, the ability, the expertise, and the network to do so. But if you got an investor and you have people who are willing to, who believe in your abilities and you've shown yourself, those are definitely Brody's marks, are right on for what you want, because you're going to have the least amount of headache in theory. The system should be fairly well in place. I mean, you don't want to have to go around building a CRM if you don't have to. You don't want to have to go and do new billing software if you don't have to. But if you've got the capital, you've got the investors, that's the way to do it. But if you have the time, the ability, and you're trying to do it on your own, you can most definitely buy a good, strong, profitable add-on business and build it into a platform.
And if you've got no money and no investors, you've also got sweat equity. That's the other option. If you've got nothing but sweat equity and a ridiculous amount of drive and the willingness to be an exceptional performer at what you do, and to, by definition, be the exception amongst all your competitors, perform at a much higher level and put a lot more into it, you've got no money and no investors, you could even start a company like this. You could start a company in an industry that you see that's like accounting or home services or something like that you already know is a fragmented industry. From the very beginning, you could build it specifically to be a platform company. So you would be building it to get as much recurring revenue as possible. You'd take care of your clients really, really well, try to get as many of them as possible early on. Then you'd take care of your staff really well and try to make sure that they're paid well, incentivized to take care of the customers well, get lots of repeat business. And you'd keep doing that until you built it up to the level where it was one of the leading competitors in your area. And then you would start buying those competitors. And I think it's important to understand that there are multiple options here.
Yeah, I mean, as we've said from the beginning, and I think it's kind of the tagline of the show, is this is a place where we want to help people of every type of situation, whether it's just starting out with little to no money and people who are seasoned investors looking for their next big deal. We want to be a resource where you can either find your deals, learn how to make a deal, learn how to invest. We want to be a resource for everyone at every level. So that's why we always try to give every single option, from I got nothing, I'm trying to get in, or I got about 5 million to go. Show me what you guys, show me how you guys would invest a $5 million deal. So that's why we always take the time to break down every single option for anyone at any level.
That's exactly right. And I want to talk about some of the market research that goes into this, because we've kind of touched on some of it. We now understand what is a platform versus what is an add-on. So as we're getting into like what it looks like to pick the right play here, whether you're starting a business, whether you're going out and finding a business to help with this, or finding a business to buy and then execute a strategy like this, you got to understand a couple of things that determine whether it's the right play. We talked about it being fragmented in the industry, and the importance of that is that there needs to be a very, very high number of potential competitors, or of existing competitors rather, in your geographic area. So typically when you execute a roll up, unless it's something that's kind of an online business where it doesn't matter the geographical area, typically you want to pick one geographic area that you're operating in, right? So if it's home services, let's say it's an electrical contracting business, and you're a really strong electrical contracting business that thinks you could continue to grow by making acquisitions, you want to make sure that you're in an area where there's a lot of other electrical contracting businesses around you, maybe hundreds, maybe thousands of potential competitors. And the most important thing is that that some of them are acquirable, that some of them are willing to sell. So as you're doing something like this, if you're taking a longer term approach with this, maybe you're building your own business to poise it for this, maybe you're going out and buying one or starting one or something like that. So many people are afraid of their competitors and they see them as the enemy. And I think this is a losing mindset. Because if you take the opposite approach, you learn from your competitors, share ideas, and actually have really good relationships with your competitors, then when you are ready to start taking your platform company and putting add-ons onto it, you might already have great relationships that could be those add-on companies. Competitors that like you, trust you, want to be a part of what you're doing, see you as a leader in the space, and want to bolt their company onto yours. And that might even give you really favorable terms that allow you to do that at a lower cost with less risk. And you'll understand the insides and outsides of their business. You won't be as worried about making that investment because you'll understand which ones are good and which ones are not good to work with. So I think that's really where like the big work of this starts. It starts potentially years in advance with just identifying those competitors. The other thing I think is the CAGR of the industry. And this kind of takes Ryan and I back to our days and getting our master's in business administration. Ryan, tell us a little bit about what CAGR is, just from like what does the acronym actually mean? What does it measure, and how does it play into the financial world?
Oh boy, I'm going to sit straight for this one. So CAGR is essentially your metric with which you're going to be.
So what does it stand for first?
Oh God, I don't remember the exact acronym,
it's
dude.
Compound annual growth rate.
Yeah. So basically it's the metric by which you're going to live and die on with your business. It's essentially the overall health of what you're doing.
And more broadly, like what the industry looks like too, I would say.
Essentially, yes, which is why we hammer on the fact that you want competition, because if you're the only HVAC in your area, I'd be suspicious. Now, what you're looking at, you're pulling data basically from everybody. You're trying to figure out what is everybody doing? How are their numbers improving? I am a big data guy. Data is king. And the reason me and Brody work so well is because Brody is a very outside the box and more creative thinker. I am to an extent, but Brody can definitely see through data and find lines where maybe I will miss them. And I'll provide Brody with all the data that he could possibly ever want to help him figure out where that next line that he wants to make his shots going to be. So CAGR is essentially your business health. You're looking at what's the rate of growth, what is the average amount going to be? How should I reasonably be able to say I should be growing year to year? Because again, you're trying to compare yourself to your competition in a good way, saying, okay, if everybody else is growing at 15% a year and I grow at 8%, I need to figure out what they're doing to be growing at that 15%. So it's an overall health check of your own business, aside from a reasonable way to tell people how you should be growing. And we know very much from our experience that investors want numbers and they want growth percentages, and you don't want to overstate them and you don't want to understate them. So you want to have a good like average of what you're going to be. And if you're off by like, I give a wiggle room of 2%. If you're supposed to be hitting 12 and you hit 10%, okay, 2% means you're almost on the mark, a little bit of a tweak. But if you're anything more than 2%, something is going wrong. And if you're over 2%, keep going. You don't need to worry about too much. If you're overshooting, you need to keep just moving what you're doing. So CAGR is a thing where it's your pulse check. It's your yearly physical of your business. How am I doing? What's everybody else doing? How should I be doing? And it's a lot. It sounds like it's a fancy thing. It sounds like it's something that you're going to need a lot of data on. But realistically, it's a couple there's couple numbers.
There's a really simple equation for it. If you can see this, it's like, what is the final value of your company? Maybe by revenue, maybe by like enterprise value or the value that it could sell for, over what is the beginning value, the starting value, over or time to the exponent of 1 over the number of years that you're measuring it over minus 1.
So that's where you started, where'd you end, and then some simple division.
So that's a really easy way to calculate it for your own company. And to Ryan's point, like understanding that for your own company is like, it's the pulse check of where are you at in comparison to your industry. So like you said, if you're under industry standard, that means you could be doing more. The other consideration here, though, in looking for a roll-up is what is the actual CAGR of the industry in general, and is this an attractive industry to begin with? Because if the CAGR is very low, if the compound annual growth rate of the industry at large is very low, it might not be the best one to be in for the next few years. There just might not be a lot of market share to go around, or the market share might be on the decline for some reason, or kind of leveling out. So when we're looking at a roll-up play, we want to understand if it's a new industry that we're getting into, we want to understand what is the CAGR of this industry, and is it a very attractive one? Does it far outpace inflation? Does it far outpace like the kinds of growth rates we would want to see? And in many cases, some of these very fragmented ones do have very strong CAGRs.
To another side of that coin, if you're seeing a lot of decline in the industries of certain business and industry, it's good to always do your own research on it. While maybe there is a sense of maybe the business is just on the decline, the industry is not healthy right now, all that stuff. I think there's certain things where if you have the knowledge or expertise in it, much like with the stock market, when things are going down, that's when the fire sale is happening. So if we saw that in a major populace, there was a large amount of HVAC companies that were looking to sell because they just weren't able to be profitable. If we had, let's say we had our network of 6, 7, 8 HVAC companies, we might go in and buy a couple because we know that we're healthy. We know a city is a populous thing, and they may just be getting eaten out because they have antiquated systems and a whole lot of other factors, but that's part of that initial reach out. So in many senses that the, fancy acronym CAGR, that's all very important stuff, but essentially where you start, where you end, and then trying to figure out that middle story is also very important. And odds are you can usually track it to, I think we've seen it, either poor bookkeeping, lack of marketing or any web presence to begin with, or third, just bad service, a company that has been coasting on its numbers for a long time and just simply has not bothered to improve or adapt in any way, shape, or form. So that's why you see a lot of these new up and comers in these areas, these young guys coming in with like their air duct cleanings and their all this other stuff where they're just eating people's lunch because, they can't compete with that sort of that energy, that desire, that growth mindset. I mean, these guys are killing it. There's people, they'll lose people. The young people in a business, we've seen them leave and start their own companies and have more success to the point where they've all left left their other people, and those guys can't compete anymore. So they got to go out of business, or they got to go join them because they're the ones doing the stuff that they weren't willing to adapt to. So beyond the CAGR, you have to understand your industry that you're looking into, because look, sometimes it's because it's a dying industry. Sometimes it's because it's a fire sale. You got to get in there and grab some stuff on the cheap.
That's exactly right. So the last little point I want to hit on here, and we've kind of already touched on this already, but the number one thing in identifying these opportunities, I would say, is just the like to really sum it all up, is the competence of what that first platform company is, because that's where the entire roll up starts. The success starts from day one with the platform company, whether it's one you're acquiring or starting. So I think it needs to be one that's outperforming the competitors. And that's something I just really wanted to hone in on. It needs to be leading amongst competitors so that it is a machine that once competitors get acquired and become part of the company, they in turn immediately start operating at a higher level because of the internal knowledge, resources, and competence of that platform business and the culture that it brings with it. It's really important that that culture and the operating efficiencies are set from the beginning, and that they really outshine those competitors that come in, so that when you do make those acquisitions, it just really all goes up from there and there's lots of growth.
Oh yeah, it's vitally important that you have just absolutely your hand on the pulse of what's going on, and that you're adapting to the competition. And I don't think the competition thing can be understated, because I think that many times people seek, I think there's a natural inclination of, like, if you Google something and there's too many of them, the gut reaction is to say, oh, it's a saturated market. Absolutely not. It is absolutely not. Because also, number one, there's probably about an equal number of businesses that you don't see on Google operating at the same time. They're doing very well because they just never did it, but the word of mouth is just too powerful, and we know this. But secondly, you have to also go into the mindset that there is a number of people, there's going to be a decent amount of people who are just kind of so-so, not sold in the service. It happens, it's a transaction, but it's not a how to phrase this, there's no relationship with the business, not in the sense of, like, a deep connected friendship, but like, when you think of that business, you don't think, oh yeah, it's just so easy, it's so great with them, they make my life so much easier because it's all taken care of. They know my dog's in the house, they know how to talk to it, they understand, their communication's great. Oh, it's so stress-free when I need I need my electrical done, or I need to have a plumbing issue, or I need my air ducts cleaned. Like that sort of thing, you have to realize that if you don't see people, and you can use, like we just did an episode on this, you can use an AI to go and scan reviews and pull out actually Google's been doing this now. You can see the majority of what people are saying about those. And if people aren't saying the things like easy, friendly, quick, responsive, start eating that up, because if you can just do that, you're going to outperform people. Even if you do the exact same work the exact same way, if you're just a little bit more responsive, enjoyable to talk to, and good to work with, people will change. Even if it's more expensive, they want the interaction.
Very well said. So to kind of sum up everything that we talked about and tie it really back in, if you are trying to find and execute a private equity roll-up, and you're looking for that right opportunity, whether it's starting a company from scratch, whether it's one you have already, whether it's one you want to buy and start from there, understand what a roll-up is, understand like how it works and what the value creation of it is, understand what is your platform company versus your add-on companies, and understand how to do your market research. You want fragmented industries where there are a very large number of acquirable competitors in your geographic area. You want to have relationships early on with those competitors and a willingness for them to come on and be part of your operation. And you want to pick an industry that has a very strong compound annual growth rate. And you want the platform company that you have to be doing very well in comparison to that compound annual growth rate. On top of that, you want the competence of that platform company to really outshine any other competitors in all ways. If you can really find an opportunity that checks all those boxes, you've got a really good roll up on your hands. Now, if you do have these pre-existing conditions, whether you're already operating a business like this, or maybe you know of a business that's prime for something like this, that would want to do something like this, these are the kinds of deals that we're looking to do. And you can get in contact with Ryan or I to just let us know about these opportunities, bring them to us, and we can help you, whether you're the business owner, we can help you get involved in a deal like this that eventually grows your company like crazy and allows you to create generational wealth building exits. Or if you're looking to get involved in these types of deals and just go source them, find them, bring them in, we're happy to help you get your career launched and learn a little bit that way as well. So message us, let us know about it, and we are happy to help talk you through it and bring it in. Ryan, where can they find you to message you about it?
They can find me on LinkedIn. I've had some great people reach out to me already. Also, Brody, this is the last episode of 2024
It is.
for DealFlow Live, and I'm really excited for 2025 because we have a slate of crazy cool guests. We got people who have come, a lot of people now. We're meeting people who are going to be guests who have come through the show and seen us, that we've talked to and are doing real big things internationally and are just all over the world. So like when we are talking about this, we're connecting and wanting to help people, not just domestically in the United States, Canada, but all over, whether it's India, China, South America, the UK, anywhere in the world. We're able to kind of help adapt, and we want to work with you and connect you and also just work with you. I mean, that's our whole thing. Our show is to help people who they got goals, they got dreams. We want to use everything in our power to help you achieve those. So 2025, let us know what your goals are. Let us know what you want to do, what you're trying to achieve. And, let's see if our show can help make it happen through what we're doing and the people we have here.
Absolutely. We're incredibly thankful for anyone who's been tuning in 2024. Yes. We appreciate you. We especially appreciate when you give comments on the live. I know this is a pre-recorded episode that we did just because we're, in the midst of the holidays here, but we appreciate the comments that you give when you're tuning in live. It really, the episodes Ryan and I enjoy doing the very most are the ones where we're getting to engage with you all, answer your questions, and get you guys involved and just learn more about the community that we're building here. So tune in, bring your questions, bring any kinds of questions that have to deal with this stuff. And like Ryan said, we've got an awesome slate of guests ready for 2025, a few return guests that have some major updates to give you that you might have seen already, some new guests that are really doing some awesome stuff in the space, some international guests like Ryan mentioned. And so if you've got questions, if you've got opportunities for roll-ups, if you got anything you want to bring to us, find Ryan on LinkedIn at Ryan Santo. Find me on Instagram or LinkedIn. Those are the best places to mention me. I'm on a bunch of other platforms as well, but message me on Instagram or LinkedIn. LinkedIn, Brody Vincent MBA, just like you see here. Instagram is brodyvincent.io, and bring us whatever you got for us. Tune in every Tuesday night at 6 p.m. Eastern Standard Time for DealFlow Live, and we'll see you on the next one.
See you in 2025.
See you next year. Everyone.